Why is nobody talking about this crypto tax method? There is more than one way to do crypto taxes. Actually, there are three. And depending on what type of investor you are, you can save thousands of dollars in taxes if you choose the correct method for you. And in this video, we are going to cover these three crypto tax methods and how you can save money. And if you are a fan of saving money, make sure to hit that like button. It really helps support the channel. And the first method that we are going to cover is the one that is preferred by the IRS, and that is first in, first out. Not only is this preferred by the IRS, but actually long-term investors prefer this method as well. And the whole goal here is finding the basis price. Let's say we sold a coin for $10. Well, how much did we pay for it? If we bought it for $1, we have a $9 profit. But if we sold a coin for $10, but we bought it for $9, we have a $1 profit. And of course, the IRS wants the profit to be bigger on paper. This is why they like this method of first in, first out, because usually with this method, the basis price will be lower, meaning that the profit on paper will be bigger, meaning the IRS will get more money. But as investors, we want the basis price to be higher, right? We want this example where we sold a coin for $10, but we bought it for $9 on paper, meaning our profit on paper is only $1. So the first method we are going to cover is first in, first out, and we are going to use a very simple example. So let's say we bought crypto in 2019, 2021, and again in 2021. And we bought this coin for $1, then we bought the coin for $5, and then we bought the coin for $10. And then in 2021, we sell one coin for $20. Well, what is the basis price? How much did we pay for it? So with the first in, first out method, the basis price will be first in, meaning this is our basis price. In 2019, first in, $1. So when we sell it, it's a $20 coin minus $1 basis price. We have a $19 profit. And then let's say we want to sell another coin for $20. Then we go to the next basis price, right? So we already accounted for this first in, and then this is next up. So 20 minus $5 basis price, meaning we have a $15 profit. So of course, the benefit here for the IRS is usually they'll get more in taxes, more profit. It's not a guarantee. It is still possible that the first time you bought crypto could have been expensive, right? For example, let's say in 2019, right, in first in, you actually bought this coin for $30, right? So when you go ahead and sell it in 2021, you'll actually be at a loss. But more times than not, with the first in, first out method over a long period, the gains are bigger. So the IRS prefers this method. But the reason why investors may prefer this method is because it's easier to get long-term capital gains. If you hold crypto for more than 1 year, the taxes are much less. If you hold it for under 1 year, the taxes are higher. So under a year, this is short-term capital gains and will be based off of your income, and it can be as high as 37%. And with long-term capital gains, or in this case, crypto held for more than 1 year, the rates are much lower. If you are single and make up to $40,000, it's actually a 0% rate. And if you're married filing jointly up to $80,000, it is a 0% rate. So you can see over here, these are the long-term capital rates, 0, 15, and 20, depending on your income. And then over here, short-term capital gains, it's much higher. So when we go back to our example of first in, first out, when we are getting the first in date, it is more likely that it was over a year ago, but it's not always a guarantee. You can still be new to the crypto space and your first in is within the same year, and you are going to get taxed on short-term capital gains. And in our first example, we sold a coin for $20 and first in was in 2019. In this case, this is long-term capital gains. But then the next coin we sold for $20 has a basis price that was bought in 2021 within the same year. So in this case, it's short-term capital gains. And I know many of you watching don't have long-term capital gains, or you're not even planning to in the future. You are a trader. Well, if you're a trader, there is a better tax accounting method. And I also know some of you are thinking, you know, this is all good, but I just want to pay zero taxes in the United States. Well, it's very difficult. There's only 3 ways really you can pay zero taxes on capital gains in the US. Number 1, move to Puerto Rico. Very unrealistic. Number 2, give up your US citizenship, your US passport. Also very unrealistic. And option number 3, creating a crypto Roth IRA. This is very realistic. This is something that I do myself with I Trust Capital. So if you want to learn about I Trust Capital after this video, I will leave a link down below explaining how it all works. And if you do decide to sign up for I Trust Capital, I have a link down below as well. And with that link, you get a $100 Bitcoin bonus. So we spoke about the first in, first out method. Good for the IRS, good for long-term investors. But what about short-term traders? There is a better option. The second option we are going to cover, I am not a huge fan of, but I'm going to cover it anyway. The third option is the one that I believe many people don't know about and they should know about. So the second option is last in, first out. So this is the opposite of first in, first out. So in this case, let's say we sold a coin for $50 in 2021. So with the first in, first out method, we would get this $10 coin as our basis price, and we'd have a $40 profit. But this is last in, first out. So instead of getting the first in transaction, we get the last in transaction. So in this case of last in, first out, we sold a coin for $50, and our basis price is over here at $25, and we have a $25 profit. And then let's say we want to sell another coin. This time we sell it at $45. Then this is the next basis cost at $15. So 45 minus 15 is a $30 profit. But there are two major downsides to last in, first out. The first major downside is that it is less likely we will get long-term capital gains, right? We are just taking the last date that we purchased crypto, meaning that it's probably not likely we're going to get those long-term gains. And then number 2, there's no guarantee that the last time we purchased was the highest price. We would assume with this method that we are going to have higher basis price, which is what we want, right? We want our profit on paper to be smaller, meaning we're going to pay less tax to the IRS. But there's no guarantee with this method. It's possible that with this method, the last time you bought actually had the lowest basis price. Take, for example, this case. Let's say you bought one coin in 2019 for $10, another in 2019 for $30, and another in 2021 for $5. Ideally, what we would want is for this transaction in 2019 to be our basis cost, meaning that our profit will be smaller on paper. But in this case of last in, first out, the last time we bought this crypto actually was the cheapest. So our profit on paper in this case will be $45, right? This is not what we want. We want a method where we can actually get the highest price paid on paper so that our profit on paper is very small. And that brings us to highest in, first out. So the first method, first in, first out, is good for long-term investors. But for traders, highest in, first out might be a better option. Over here, it doesn't matter if it was first in or last in when you bought it. It simply finds the highest price you paid. So with this method, you will have the highest basis price, which will lead to a smaller profit on paper, meaning smaller profit on paper, less money you're going to pay to the IRS. So in this case, let's say we bought a coin in 2019 for $10, again in 2019 for $30, and then in 2021 for $5, and then we sell a coin in 2021 for $50, our basis price will simply be the highest in. It doesn't have to do with date. And another benefit here of highest in, first out is that sometimes the highest price you paid could have been over a year ago, meaning you're going to get long-term capital gains, but also it could have been very recently, meaning you're going to get short-term capital gains. So in this example, let's say you bought some coins in 2018 and 2019, and then you bought another coin in 2021, and that was the highest price you paid. So they will use this as your basis price when you sell a coin, meaning your profit will be $10, right? So smaller on paper, but in this case, it is a short-term capital gain. Whereas with this example, the coin that you paid the highest price for was in 2019, over a year ago. So with highest in, first out, it is much more beneficial for short-term traders. And even when using this method for short-term traders, you may end up getting long-term capital gains as well. So first in, first out, usually good for long-term traders. Highest in, first out, usually good for short-term traders. And last in, first out, I personally am not a fan of. And you're probably wondering, how do I do this myself? And the answer is you don't. This is done with crypto tax calculators. So I myself, I've used cryptotrader.tax for many years. And if I go into tax settings and I go to report calculation method, I can choose first in, first out, last in, first out, or highest in, first out. And a common question that I've gotten in the past is, can you use two of these methods at the same time? And the answer is, that's something you need to ask your accountant, a tax professional, because that can get very complicated. Usually, when you choose a calculation method in crypto, you stick to that method. If you want to use more than one method at the same time, like I said, it could get very complicated and something that you probably want to speak to your accountant about. And if you want to use cryptotrader.tax, I do have a link down below. And with that link, you will get 10% off. And if you want to learn about crypto Roth IRAs and how you could pay 0% tax on crypto gains, go ahead and watch this video, link right above and in the description down below. Thank you for listening, and I'll see you next time.